In February of 1946, the United States carried a financial burden of $269 billion, representing 119% of our entire economic output. By 1960, this figure had seen a minimal increase, standing at $286 billion. However, the crucial metric of the debt to gross domestic product ratio had drastically fallen to a mere 55%. Our government did not retire any portion of this debt through direct repayment. Instead, they implemented a far more sophisticated strategy, rendering the debt insignificant. And it appears they are poised to employ this tactic once more. What if I were to reveal a financial strategy that our government has utilized previously, a method so potent that it effectively eliminated half of our national debt within 15 years without a single dollar being physically paid back? This particular approach is absent from conventional economics textbooks, and the vast majority of Americans remain unaware of its historical application. Yet the underlying infrastructure is already established, the mechanisms are being prepared, and your personal savings are on the cusp of fueling the most substantial wealth redistribution event in contemporary history. Envision this scenario. April of 1942. Within the hallowed halls of the Federal Reserve Building in Washington, D.C., Chairman Mariner Eccles convenes with Treasury Secretary Henry Morgenthau, Jr. Their discussion is not one of military tactics, but rather the architecting of the most monumental financial illusion in American history. The agreement they are about to forge will discreetly siphon hundreds of billions of dollars from ordinary citizens into government coffers over the subsequent decade. The majority will not comprehend the unfolding events until it is far too late. Here's the essence of their pact that fateful spring morning. The Federal Reserve committed to capping Treasury bond yields at 2.5% for the duration of the war and extending into the post-war period. This might sound like a highly technical detail, but its real implication was profound. With inflation soaring between 6 and 8% annually, every American who purchased war bonds was effectively losing 3 to 5% of their purchasing power each year. If you lent the government $100, they promised to return $112.50. However, that $112.50 would only possess the purchasing power equivalent to $97 at the time of the initial loan. This arrangement persisted for 9 years. It was lauded as a patriotic duty, a necessary contribution to supporting our troops. What it was not termed, however, was its true designation: financial repression. This represented the government's clandestine strategy for eradicating debt without resorting to default. Allow me to illustrate its mechanics with concrete figures. Between March of 1942 and March of 1951, the Federal Reserve maintained a ceiling on long-term Treasury bond yields at 2.5%, a directive emanating directly from the Treasury. During this same period, the average annual inflation rate registered at 5.7%. Perform the calculation. The real interest rates experienced an average of negative 3.2% for nearly a decade. Contemplate the ramifications of this. The government procured a $20 billion loan to finance the Second World War, while simultaneously ensuring that every bondholder systematically saw their purchasing power diminish year after year. The truly remarkable aspect, however, emerges when examining the period from 1946 to 1955. Throughout these years, the total U.S. government debt remained remarkably static, oscillating between $270 billion and $275 billion. Yet concurrently, the debt-to-GDP ratio plummeted from 119% to 71%, a substantial reduction of 48 percentage points. How could this be achievable? The underlying mechanism was elegantly straightforward. Nominal GDP surged from $227 billion to $415 billion, an 83% expansion largely fueled by inflation. Cumulative inflation during this time frame reached 44%. Consequently, every dollar of debt incurred in 1946 was, in real terms, worth merely 56 cents by the end of this period. The government did not literally repay the debt, rather, it devalued the debt to the point of irrelevance as the economy grew around it. Reflect upon your grandparents or great-grandparents who invested in Liberty bonds and Victory bonds. They believed they were making a prudent investment, a means of supporting their nation and securing their financial future. Liberty bonds, which were sold at a face value of $100 during the First World War, were worth approximately $47 in inflation-adjusted terms by 1951. Bonds issued for the Second World War fared even worse. A $100 Series E bond purchased in 1942 and held until its maturity in 1952 yielded $133 in nominal currency. This might sound like a gain, but when considering the cumulative inflation of 48%, the actual return was negative. Your ancestors received their principal back in dollars that held less purchasing power than when they initially lent them. On April 9, 1951, a pivotal change occurred. The Treasury Federal Reserve Accord formally absolved the Federal Reserve of its obligation to support Treasury prices. However, by this juncture, the damage to bondholders had already been irrevocably inflicted. The financial illusion had executed its purpose flawlessly. Our government had successfully financed the costliest war in human history and emerged with a debt burden that was already dissolving. You might be inclined to believe that these measures were specific to wartime emergencies, one-off solutions. However, this is precisely where your attention should be sharply focused. This was not an oversight in the system, it was a deliberately integrated feature that has been recurrent throughout our history. The framework established in the 1940s became the definitive blueprint: central bank cooperation, strategic manipulation of interest rates, the creation of a captive domestic investor base through banking regulations compelling institutions to hold government debt, and a systematic devaluation of the currency through inflationary policies. The government does not genuinely need to repay its debt in any meaningful sense. Its primary objective is to manage the debt-to-GDP ratio. The strategy is elegantly simple. Suppress real interest rates below the rate of economic expansion, particularly when growth is inflation-driven. Allow nominal GDP to outpace the growth of debt levels and observe the ratio shrink. Who bears the cost of this maneuver? Bondholders, savers, essentially anyone holding cash or fixed income investments. Their wealth is systematically transferred to the government via negative real yields. Allow me to provide a relatable analogy. Imagine you owe your neighbor $100,000 with an annual interest rate of 2%. This sounds manageable, does it not? Now picture your income doubling over the ensuing decade while the dollar's purchasing power is halved. You continue to pay the same $2,000 in annual interest, but this amount now represents merely 1% of your income as opposed to 2%. And when you finally repay the $100,000 principal, it will only purchase what $50,000 would have bought at the time you initially borrowed it. You have effectively halved your real debt burden without any personal sacrifice. Your neighbor, conversely, has absorbed the consequences. This is precisely what our government achieved between 1946 and 1960. Bondholders, American citizens, banks, insurance companies, and pension funds were the neighbors who were repaid with devalued dollars. The wealth did not vanish. It was transferred from those who saved to those who borrowed, from the private sector to the government, from individuals who trusted the promise of fixed returns to an entity possessing the power to alter the rules of the game. The critical question you should be posing at this very moment is this: with our national debt standing at $36 trillion and continually increasing, with our debt-to-GDP ratio once again exceeding 120% for the first time since the Second World War, and with annual interest expenditures approaching $1 trillion, do you genuinely believe our government intends to repay this debt in full value dollars, or are they preparing to deploy that same strategy once more? History does not repeat itself precisely, but as the adage goes, it often rhymes. And currently, if you are attuned to the subtle signals, you can discern the familiar rhythms beginning to emerge. The Federal Reserve has already initiated coordination with the Treasury's financial requirements. Banking regulations have already established captive pools of capital that are mandated to flow into government bonds. The stage is set, the players are in position. The only uncertainty is whether you will recognize the unfolding drama before it is too late. So how does the government actually orchestrate this feat? How do they make trillions of dollars in debt effectively disappear without inciting public outcry or upheaval? The answer lies in a complex web of laws, regulations, and institutional arrangements so intricate that most Americans are never exposed to their details. However, once you understand the underlying machinery, its presence becomes undeniable. Financial repression operates through three distinct but harmoniously coordinated instruments. Firstly, our central bank maintains nominal interest rates below the prevailing inflation rate, thereby generating negative real yields on government bonds. Secondly, regulatory capture effectively compels domestic financial institutions, your banks, your pension funds, your insurance companies, to hold government debt irrespective of the returns they are earning. Thirdly, capital controls or regulatory penalties effectively prohibit individual savers, such as yourself, from reallocating your capital into inflation-protected assets or foreign currencies. The consequence is a captive pool of domestic savings that is systematically channeled to the government at below-market rates over a period of 10 to 15 years. This strategy can reduce the debt-to-GDP ratio by 30 to 50 percentage points without any actual repayment of principal. Allow me to elucidate the specific legislative measures that constructed this apparatus. We begin with a piece of legislation you have likely never encountered. On January 15, 1933, the Banking Act introduced what is known as Regulation Q. This might sound like a mundane piece of legislation, but its impact was substantial. It granted the Federal Reserve the authority to establish maximum interest rates that commercial banks could offer on savings accounts. For the subsequent 53 years, banks were prohibited from competing for customer deposits by offering market-driven interest rates. They were legally forbidden from doing so. Consider the implications for the average American attempting to save. During the 1940s, your savings account might have yielded 1 to 2% interest, while inflation was rampant at 5 to 8%. You were effectively losing 3 to 7% of your purchasing power annually with no legal recourse. The law prevented banks from offering you a fair rate of return. By 1980, this situation had reached an almost ludicrous extreme. Passbook savings accounts were legally capped at 5.25%, while inflation surged to 13.5%. This represented an annual wealth transfer of 8.25% from every American saver to the banks and their principal borrower, our government. However, Regulation Q served merely as the foundational element. The truly transformative development occurred on August 15, 1971. President Nixon appeared on television at 9 o'clock Eastern Time and delivered an announcement that would fundamentally alter the global financial landscape. He declared the suspension of the dollar's convertibility into gold at the fixed rate of $35 per ounce. The Bretton Woods system, established in July of 1944, effectively ceased to exist in the span of a single evening television address. What President Nixon omitted from his broadcast was the fact that he had just removed the last vestige of control over unlimited dollar creation. Under the Bretton Woods Agreement, foreign governments retained the right to exchange their dollars for gold, a provision that necessitated a degree of fiscal discipline from the United States. With that linkage severed, the printing press operated without any inherent limitations, and the market swiftly reflected this newfound freedom. Within 2 years, gold prices had soared to $120 per ounce, a staggering 240% increase that starkly illustrated the extent to which the dollar had already depreciated. The figures paint a clear picture. At the time of Nixon's announcement, U.S. debt stood at $398 billion, approximately 35% of GDP. This was, by historical standards, a relatively manageable figure. However, observe the subsequent trajectory once these constraints were lifted. Over the following decade, the money supply, as measured by M2, experienced a dramatic surge, expanding from $685 billion to $1.6 trillion, a 133% increase. Inflation averaged 8.8% annually between 1973 and 1981. Consequently, a dollar in 1971 would possess the purchasing power of only about 35 cents by 1981. Now, observe the magical transformation. From 1973 to 1980, Federal Reserve data indicates that the average yield on 10-year Treasury bonds hovered around 7.8%. This might appear to be a favorable return. You were earning nearly 8% on your bonds, yet inflation was averaging 9.2%, your real yield, the actual return after accounting for inflation, was a negative 1.4%. You believed you were accumulating wealth, but in reality, you were steadily losing purchasing power year after year. Total U.S. debt increased from $458 billion to $980 billion during this period. The government borrowed an additional $450 billion. However, here lies the crucial element. The debt-to-GDP ratio remained remarkably stable, fluctuating between 32 and 33%. This stability was achieved because nominal GDP experienced a dramatic surge, escalating from $1.38 trillion to $2.86 trillion. Despite borrowing nearly $500 billion, the actual debt burden diminished due to the impact of inflation. The Federal Reserve Bank of New York, under Chairman Arthur Burns from 1970 to 1978, explicitly facilitated the Treasury's borrowing needs. The Federal Reserve's independence devolved into a mere formality. Have you begun to discern a pattern? Each time our government encounters a debt crisis, the solution remains consistently the same. Inflate the debt away while assuring savers that they are receiving an equitable return. The specific figures and individuals may change, but the underlying mechanism is invariably identical. In March of 1980, Congress enacted the Depository Institutions Deregulation Act, finally initiating the dismantling of Regulation Q. However, by this point, the government had already secured decades of borrowing at below-market rates. Economists Carmen Reinhart and Ambelen Saprizia, in their 2015 IMF working paper titled The Liquidation of Government Debt, estimated the total wealth transfer from savers to the government between 1945 and 1980 at approximately $800 billion, measured in 1980 dollars. This figure is equivalent to $2.9 trillion in today's currency. This represents nearly $3 trillion quietly extracted from American savers over 35 years through the mechanism of negative real interest rates. However, then came an unprecedented development. In October of 1979, Paul Volcker assumed the chairmanship of the Federal Reserve and resolved to actively combat inflation rather than accommodate it. He raised the federal funds rate to a staggering 20% by June of 1981. 20%. He deliberately engineered a recession to break the back of inflation. Consequently, real interest rates surged to a positive 8%. For the first time in decades, the debt servicing mechanism reversed. Savers began to earn real returns, and the government was compelled to bear the actual cost of its borrowing. By 1983, interest payments constituted 10.1% of federal expenditures, a significant increase from just 6.5% in 1979. This experiment demonstrated a critical truth. At elevated debt levels, our government simply cannot sustain positive real interest rates. However, here is why Volcker's drastic intervention succeeded then, but would be utterly unfeasible today. In 1979, total U.S. debt stood at $98 billion, roughly 31% of GDP. Even with interest rates at 20%, the government was capable of managing the payments. Today, we are burdened with $36 trillion in debt, representing 123% of GDP. If we were to attempt Volcker-esque interest rates now, the interest payments alone would consume 40 to 50% of all tax revenue, leading to the collapse of the entire federal budget. Volcker's policy was viable only because the debt was manageable. We have now surpassed that threshold. And this is not solely an American narrative. Following the First World War, France and Italy reduced their debt, which had exceeded 150% of GDP, through inflationary measures in the 1920s. After the Second World War, the United Kingdom managed to diminish its debt from 238% of GDP in 1947 to 47% by 1980, again, without ever fully repaying it in real terms. Japan attempted a similar strategy between 1998 and 2013, albeit with limited success. The institutional architecture employed is invariably consistent: the central bank's subservience to Treasury funding requirements, the regulatory entrapment of domestic savers, and controlled currency devaluation. The Federal Reserve Bank of New York serves as the central operational hub for all these activities. It executes all open market operations, houses the foreign exchange desk, and manages the primary dealer network through which Treasury securities are distributed to banks and financial institutions. When you hear discussions about Federal Reserve policy, you are essentially hearing about a coordination mechanism between our central bank and the funding needs of our Treasury Department. Pop quiz. Do you believe the interest rate offered on your savings account is determined by free market competition, or do you surmise it is established by a regulatory framework designed to ensure inexpensive funding for government debt? If your answer is the latter, you're beginning to grasp the operational principles of this system. The necessary infrastructure is in place, the legal framework is fully established, the institutional arrangements function precisely as intended, and with a debt burden of $36 trillion that can never be repaid in full value dollars. The only remaining question is when the switch will be activated. Your wealth is currently ensnared within this mechanism, and the gears are already beginning to turn. In September of 2024, our national debt officially surpassed $36 trillion. The Congressional Budget Office projects a deficit of $1.9 trillion for the fiscal year. However, the figure that should truly command your attention is this. With our debt now equivalent to 123% of GDP and an average interest rate hovering around 5%, we are expending approximately 6.2% of our entire economic output solely on interest payments. Not principal, merely interest. This amounts to $1.14 trillion annually, exceeding our defense budget and rapidly approaching our Medicare expenditures. The mathematical equations have become untenable, and when the mathematics become impossible, the government does not alter the equations. They alter the currency. Let me illustrate when this apparatus began operating at its full capacity. From March 15, 2020 through December of 2021, a mere 21-month span that will be meticulously studied by economists for generations to come, the Federal Reserve dramatically expanded its balance sheet from $4.2 trillion to $9 trillion. This represents an increase of $4.8 trillion. To provide context, this expansion accounts for 40% of every dollar that had ever existed within the American money supply. 4 decades of dollar creation were condensed into less than 2 years. The M2 money supply, which encompasses essentially all dollars circulating in our economy, along with savings account balances, surged from $15.5 trillion in February of 2020 to $21.7 trillion by March of 2022, a 40% increase. This surge engendered precisely the outcome one would anticipate, a significant inflationary spike from 2021 to 2023. The Consumer Price Index reached 9.1% in June of 2022, the highest level recorded in over 40 years. Here is where this becomes personal. Real yields on 10-year Treasury bonds plummeted to negative 4.8% in March of 2022. Consider the implications for an individual who invested $100,000 in 10-year Treasury bonds in March of 2020, when yields were a mere 1.15%. They believed they were making a prudent and conservative investment. By March of 2023, they had suffered an approximate $18,000 loss in purchasing power. The mechanism employed is identical to what transpired in 1946, albeit compressed into 3 years rather than spread across a decade. However, September 18, 2024, marked the point at which this strategy became undeniably evident. The Federal Reserve executed an interest rate reduction of 50 basis points, an unusually aggressive move. Federal Reserve Chairman Jerome Powell cited a softening labor market as the justification. However, observe what else occurred during that same week. The Treasury Department's quarterly refunding announcement revealed a requirement for $776 billion in net new borrowing solely for the fourth quarter of 2024 at restrictive interest rates of 5.25%. These annual interest costs would escalate to $1.14 trillion for fiscal year 2025, surpassing our defense budget of $874 billion and approaching Medicare spending at $839 billion. The Federal Reserve's cessation of quantitative tightening commenced in October of 2024. The message conveyed was unequivocal. Treasury funding needs superseded the imperative of inflation control. The Federal Reserve's independence endured only as long as the national debt remained manageable. At $36 trillion, we have crossed an event horizon beyond which positive real interest rates would literally consume the entirety of the federal budget. The Congressional Budget Office released updated projections in February of 2025, and these figures reveal the extent of our entrapment. Under current legal frameworks, and assuming no recessions, wars, or financial crises, the national debt is projected to escalate from $36.22 trillion today to $56.4 trillion by 2034, representing 135% of GDP. Interest costs alone are projected to reach $1.6 trillion annually by that time, approximately 3.9% of GDP. However, here lies the predicament within the predicament. These projections are based on an assumption of average interest rates around 3%. What would transpire if rates were to remain at 5%? In that scenario, interest on $56 trillion would amount to $2.88 trillion annually, exceeding Social Security's projected budget of $1.9 trillion. The mathematics are simply insurmountable. There exists no combination of spending cuts and tax increases that can rectify this situation. The sole viable solution is financial repression, maintaining interest rates below the rate of inflation, devaluing the debt, and transferring the associated costs to savers and bondholders. Furthermore, the necessary infrastructure is already firmly in place, mirroring the period between 1942 and 1951 with remarkable accuracy. Basel III capital requirements mandate that banks hold Treasury securities as Tier 1 capital, thereby creating a captive audience of buyers who are obligated to purchase government debt regardless of the returns offered. The Treasury Department has strategically increased the average maturity of our national debt from 70 months in 2020 to 73 months in 2024, effectively locking in lower interest rates for extended periods. The exemption from the supplementary leverage ratio for Treasury securities, initially introduced in March of 2020 and subsequently made de facto permanent, permits banks to hold unlimited quantities of government debt without incurring capital charges. The reverse repurchase facility operated by the New York Federal Reserve absorbs over $500 billion in money market liquidity, thereby preventing it from driving up Treasury yields. Every component is meticulously positioned. Thus, who stands to gain and who will suffer when this reset fully takes effect? The beneficiaries are evident. Our national government possesses the capacity to reduce its debt-to-gross domestic product ratio from 123% down to 75% over a span of 15 years, utilizing negative 2% real interest rates. This approach would effectively eliminate in excess of $13 trillion of actual debt burden without necessitating any reduction in the principal amount owed. Holders of tangible assets, individuals possessing real estate, infrastructure, raw materials, and company shares will witness their asset values appreciate nominally in line with inflationary pressures. If you acquired a residence in 2010 for $200,000 that is now valued at $500,000, you have already personally experienced this very financial dynamic. Borrowers with fixed-rate obligations, encompassing mortgages, educational loans, or corporate borrowings, will find their repayment commitments becoming more manageable as wages climb, while the actual payment amounts remain constant. The primary financial institutions, such as Goldman Sachs, J.P. Morgan, and Bank of America Securities, stand to gain from the profit margins on Treasury securities trading and Federal Reserve operations. Between the years of 2020 and 2021, the trading revenues generated by the 5 largest such dealers surpassed $150 billion. However, for every party that profits, there is an offsetting loss, and these losses are substantial. Investors holding long-term Treasury bonds, corporate debt instruments, or any other fixed-rate investments will observe their purchasing power systematically diminished. There are $10 trillion of United States Treasury bonds currently held by the public, yielding negative 2% in real terms. This translates to an annual real wealth erosion of $200 billion. Savers who maintain their funds in cash, which currently amounts to $18 trillion across savings accounts, Certificates of deposit and money market funds are earning 4 to 5% nominally, while inflation persists at 3 to 4%. Consequently, they are losing purchasing power on a daily basis. 46 million Americans aged 65 and older who rely on bond portfolios and fixed income for their retirement security will face a reduction in their accustomed living standards due to persistently negative real yields for years to come. Furthermore, this situation impacts the United States dollar itself as the world's preeminent reserve currency. Foreign central banks held $7.6 trillion in United States Treasuries as of December of 2024. These institutions are encountering the identical wealth erosion experienced by domestic investors, which is accelerating the trend of diversification into alternative assets. Gold's share of central bank reserves has risen from 15% in 2015 to 30% presently. The Chinese yuan, notwithstanding its inherent challenges, is steadily increasing its global standing. The privileged status of the United States dollar as the global reserve currency, a position held since 1944, is gradually but surely being undermined, one negative yielding bond at a time. In February of 1946, the United States national debt stood at 119% of its gross domestic product, and this was effectively eliminated without a direct repayment of the principal. In February of 2025, the United States debt stands at 123% of its gross domestic product. The identical strategy employed previously is now readily available, not as a clandestine scheme, but as the sole mathematically viable resolution. The independence of the Federal Reserve was maintained only for as long as the national debt remained manageable. With the debt at $36 trillion, positive real interest rates would consume the entirety of the government's budget. The anticipated economic recalibration is not slated for 2027. Rather, it commenced the very moment the Federal Reserve shifted its policy stance in September of 2024. The necessary infrastructure is already in place, the operative mechanisms are engaged, and the redistribution of wealth has already begun. The sole remaining uncertainty is whether your personal wealth is positioned to benefit from this impending economic shift, or if it will be directly overwhelmed by its effects. While history may not repeat itself precisely, the underlying mathematical principles remain constant.